Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Tom Beckett, Chief Investment Officer of Sigma. Hi Tom.
Hi Emma.
So we're here today to give your predictions, if you will, for 2016. Before we jump into the new year, perhaps we could have a look at last year. Last year everybody said that the US was not going to do so well, but actually seemingly it wasn't that bad.
Yeah, I mean, I suppose the US was actually a pretty good indicator for the rest of the world. You know, bumpy, volatile, and ultimately not much reward and return achieved. So if you look at the US market, the S&P in capital returns terms was effectively flat. Adding dividends is up a couple of percent. For UK investors, it was slightly better because the pound weakened against the dollar towards the end of the year. But ultimately, the market was driven by a very small number of very high growth stocks. It was a very narrow market. Making money in the US last year was difficult, and actually really making money across the world was pretty difficult last year, unless you were actively invested in places like Europe and Japan, which at the start of the year were quite contrarian, by the end of the year were quite consensual. It was difficult to make money, and that's not just in equities. Most asset classes are pretty lackluster last year. It wasn't a great year to be an asset allocator. Let's hope this one's going to be better.
And perhaps that's the point then. You know, you said all the reasons why the US didn't perhaps work, but actually, of a very bad bunch, a positive return was not bad because, of course, in the UK you got less than that. You got negative returns in the FTSE 100 at least. Yeah,
no, I think that's right. I think probably perhaps focusing on the FTSE 100 just on a capital return basis is probably the wrong thing for investors to do. All that's the obsession. There was money to be made last year in UK equities, and actually active funds had a very good year last year, mostly because a lot of the damage done to the FTSE 100 rather than the FTSE All Share was in the energy and materials space, where people were very unwilling to take a positive view. So active money made quite good money in the UK last year, but still it's not great returns to write home about. You know, most active funds probably up 2 or 3%, better than some places, but ultimately a lot less good than people's expectations.
Well, with all that cheery news, shall we perhaps go to forward looking? Let's start with the domestic market. As you say, FTSE 100 was down, but active managers a couple of percent up. What are we looking for the domestic market 2016?
Well, hopefully better than the first day of the year, but that's not going to be too high a bar to clear, to be in all honesty. And I think ultimately, you know, the UK will be reflective of what happens in the global economy. That's really what the UK market does. It's quite a good barometer for global activity, and we think probably solid but unspectacular. So I think returns from the UK market itself will be solid but unspectacular. I'm asked by lots of people like yourself for a year-end FTSE 100 prediction. It's nearly always wrong, I hasten to add, but you know, I think ultimately we could see a sort of 6% capital return, adding dividends. I think a 10% return from the FTSE All Share this year is probably about right. And I think rather than the return obsession, perhaps focusing on what might drive that, I think the UK market could be quite an interesting battleground this year between that stuff that everyone loves on the one hand, UK consumer-focusing businesses, things like house builders, all those things which have been done well because the UK economy's been okay and interest rates have been low, and actually focusing on those things now that everyone hates, things like energy, materials, banks. Those have actually suppressed market returns in the last few years. I think actually this year there could be quite a big inflection point, and actually in our portfolios we're taking a much more passive focus at this point in time than an active focus.
Because it's a brave bet to make to look at those things that have lost. I mean, there's been some mining stocks out there that have lost 70% in 2015, and to then turn around and think, oh, you know what, I'll put my cash in there, is a difficult contrarian thing to do.
Yeah, but I didn't get into the industry. Well, that seemed much easier a decade ago to try and find things that everyone felt were safe and secure and comfortable. Ultimately, history has taught us that those sorts of trades actually don't make you much money, although you can perhaps sleep well at night looking on a backward-looking basis. I think 2016 could well be a year when you see major inflection points in the performance of certain different asset markets. Let's think about the things that did badly last year. US high yield credit did very, very badly. This year looks quite attractive, I would say. Things like the energy sector. Yes, I haven't got a clue what's going to happen on a 6-month view. On a 6-year view, I think you can probably double your returns in the energy sector as an example. So I think all around the world. Well, I think that's actually another classic case in point. You know, the emerging markets have performed poorly for the last few years, but if you divide up emerging markets now against developed markets, emerging markets, everyone hates them. Everyone's quite comfortable with developed markets. Emerging market equities cheap, developed market equities arguably quite expensive. Sentiment towards emerging markets, dreadful. Sentiment towards developed markets, pretty safe and secure. So on a 5-year view, ultimately go and buy some emerging markets, and it would seem wrong at this point to have a zero weighting in the asset class. And I think being anything other than neutral now probably leads to uncomfortable times when those markets start to recover. So that could well be a classic example of those things from 2015 that did badly, doing well in 2016, and that is my view.
Tom, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.